Good afternoon, and thank you for tuning in to the DoubleLine Closed-End Funds webcast titled Steering DBL, DSL, DLY Amid Growth, Inflation, and Credit Crosscurrents. A bit of a mouthful, but true. My name is Chris Stegeman, and today's webcast is featuring DoubleLine Deputy Chief Investment Officer Jeffrey Sherman, and I'll be handing it over to Mr. Sherman in just a minute. But first, just a few housekeeping items. Here we have our content announcements, all of which can be found on YouTube, including a conversation with Mr. Sherman and Rick Caruso on the commercial real estate market. Additionally, on the right-hand side here, our upcoming webcast schedule. You'll see on September 10th, DoubleLine CEO Jeffrey Gunlock and Portfolio Manager Andrew Hsu will be hosting the Total Return webcast, where they will discuss markets, their outlook, and the DoubleLine Total Return Bond Fund. You can also register for upcoming webcasts at doubleline.com. And in order to receive a copy of today's slides, just simply click Request Webcast Content tab here in the player. Moving on to other forms of DoubleLine thought leadership. Certainly YouTube and X are great resources to find a lot of this. DoubleLine's Channel 11, which features Portfolio Manager Ken Shinoda, and of course the Sherman Show podcast, which is available really anywhere one may find their webcasts. Their podcasts. Again, YouTube and X. You can follow us on X at DoubleLine Capital. And then today, Mr. Sherman, who I'll turn it over to just shortly, is going to discuss macro and our three closed-end funds, DBL, DSL, and DLY. So on these next three slides, we just have simple performance pages, starting here with DBL. We had our last closed-end fund webcast last July, so just looking at how have things done since then. This is as of June 30th, pointing your eyes towards that one-year return as of June 30. All three have done quite well, as credit has largely rallied since that time. You'll see DBL up 15.71% on market and 52% on NAV, which is, of course, what we can control here at DoubleLine, and has a 30-day SEC yield of 12.9. Moving on to DSL, the Income Solutions Fund. Again, looking at that 1 year, up 17.21% on market, 17.43% on NAV, and a 30-day SEC yield of 14.63. And then last but certainly not least, our most recently launched closed-end fund, DLY, which is the Yield Opportunities Fund. You'll see on that 1 year, from a market perspective, up 19.62, and on an NAV perspective, up 16.16, and a 30-day SEC yield of 10.83. So with that, I will turn it over to Deputy CIO Jeff Sherman.
Hi, Mr. Stegman, thanks for the introduction there, and I'm glad I could get you a little tongue-tied on the title that we created, with it being a little cumbersome. However, looking through all of that too, I think that it is really important now as we get to the middle of the year, we kind of reflect on what we're seeing in the marketplace. And I think these are really kind of the three key metrics. Will growth continue? Is it sustainable? What is the outlook on inflation? Where are we in the overall cycle? I think there's some pretty positive news coming in on that front. And what does it mean for the cross currents of the credit markets? And so that's the way I'm going to approach today. As you guys are all aware on the call, the closed-end funds tend to be more heavily credit focused. And so I'll spend some time in details talking through a lot of that and essentially what that means for the portfolios and our outlook on that as well. So without further ado, let's start with the macro landscape and where we are today. And I like to use this picture, even though it goes back to 2010. And I do this ever since the pandemic to show how tight of a range the U.S. economy really grew in the post-GFC era. Obviously, the big gap down in 2020 to the pandemic, then you're going to get the recovery on a year-over-year basis with all the various stimuli that occurred. But what you can see here now is, for looking at the 23, and you look at that purple line, although there was a lot of downgrades to the economy for 23, turned out to be a pretty good year overall. The 23 outcome ended up producing about a 2.5% real GDP growth, which I'll show you is slightly above average post GFC. And here we are in 2024, kind of grinding along. The updates when we ran this yesterday was 2.3, and I would expect those to maybe increase a little bit after the retail sales data we saw specifically in the control group being somewhat positive today on a month-over-month basis. And so you put it all together, what this says is that outside of those kind of aberration years of, call it 2020 and 2021, the U.S. economy is kind of back to that kind of level of growth that we were. And another way of illustrating that, because this is all forecast, obviously the forecast will migrate to that official data trend. But if you take a look at it on the screen, what we show here is the post-World War II era of looking about how GDP grew. And so this is real GDP. So this is inflation adjusted, of course. It's a logarithmic scale. So if you use the log scale, the slope of that line is actually the growth rate. So it doesn't turn into this parabolic function as you go over time. But notice how tight that trend line was until really we broke down something around the global financial crisis. You can see that GDP was a little under trend at that point in time. And then once we had the GFC, essentially we set a new growth rate. And what's important by looking at this slope of these lines, again, using these log scales, you can actually see that that is the difference in the growth rate, right? So the growth rate has flattened somewhat in this post-GFC era. Maybe it's some of the debt, maybe it's the policies, maybe we should have had a better cleansing cycle on the credit markets and actually have, kind of a business cycle recession during that period. But in general, you can see outside that kind of dip down we saw in the pandemic, there was a little overshoot if you looked at it, but we're back on this kind of trend line growth again. And so, for all the things that are made of U.S. exceptionalism, and I know some of our macro team has used that phrase a few times, we're kind of just back to where we were. And so, all of the policies that took place, whether that's via monetary or the fiscal side, got us back to these levels. And so it's nice to have, a slightly higher than what we had growth rate and go last year's 2.5, where the post GFC trend was close to like 2.3. But again, splitting hairs on that large of economy pretty much says that we're back to kind of this long-term trend growth. And I'm calling the long-term just that post GFC era. And so one thing we also like to look at is like, how is the data delivering relative to expectations? And so Citigroup puts out a nice series, and they're regionally put together by the US, Eurozone, China, and EM. And what you can see here is that the US has started to actually surprise to the downside. Now, a downside surprise, it all depends on where expectations were, right? But you can see for the entire period of almost during 2023 that the economic data actually delivered above expectations. And so some of that happened at the very beginning of this year. Some of those expectations got reset upward a little bit. And that's why you're seeing some of these surprises to the downside. But the data is a little bit weaker. It has been over the last couple of months. I'll get into that. But what you see here is that pretty much everyone is somewhat disappointed. EM is a little bit above expectations right now, but where the rest of the world was mired in delivering below expectations in the second half of 23, what you're seeing is that the US was that kind of shining star. Now, it's not to say we're losing our luster here, but again, we're getting back to these kind of areas where I think we're back to this kind of trend growth. It's going to be about a function of the labor market growth and essentially how consumption holds in there. And that's going to dictate the fate of whether this is indeed that kind of soft landing narrative that people were talking about over the last 2 years. You can't really turn on the financial media, or you can't really read about anything about people talking about how important it is to have rate cuts, how the rate cuts are super important. And obviously risk markets like rate cuts. Again, it makes conditions a bit easier. But if you dig through the pieces of the financial components that Bloomberg puts together, those financial components create what they call tightening or tight or accommodative conditions. Look at the way that this graphic is showing you today. During the whole period, again, this is using these metrics, and you can see some of the details that are listed in the legend. But conditions are pretty accommodative. Now, it may not feel like it if you're trying to go buy a house today, or you're out there trying to get a personal loan, or something where your rates are a bit more tied to kind of these SOFR type of rates. But in general, what this says is that the market is somewhat accommodative when you look at the way the spreads are behaving. Again, volatility measures, things like the performance of the stock market. And so all in all, what you kind of find here is that it sure does look like conditions are somewhat accommodative out there still. So for all this hand-wringing about, the Fed needs to cut, it's important, we need to have it, markets aren't really reflecting that stress out there. And again, that's why You're seeing kind of new highs in the equity market. Spreads are relatively tight in a lot of credit products, and a lot of that is just extrapolating those conditions. But kind of a warning sign, and what you see here is two charts. These are two pieces of the U.S. economy, and this is done by the folks at ISM, and they put together these manufacturing indices, or so they put together these PMI indices. One is manufacturing, and one is services. And so this time series is one that kind of it's a color diffusion index. The way it works is that it asks how many people respond in the affirmative versus the negative. And so they're hard to say, well, a 60 is massively better than a 55, but it kind of gives you a directionality of things. And what you can see here is that for the first time, this happened 2 months ago. We got a big bounce back last month, but the most recent print on the service data is below that 50 level. And so that says that the activity, people are responding more negatively than positively about the service part of the economy. And so what you have to go on watch here and look for this, because in the last few recessions, it's when that service side collapses that you have this problem. You can see manufacturing's been mired here for a period of time, call it about 18 months or so, that's been giving you this kind of negative reading. But when you have both of these together and that sub 50, you got to start being cautious. And so again, it may take a little bit of time to bear this out. As I said, 2 months ago, we got one of these readings on the services, big bounce back last month. And then the most recent data print was a bit weak. So something to keep our eyes on. We won't get another print for about 3 weeks. It comes out at the beginning of the month. But this is definitely something to think about, as services is a big driver of the overall economy. And we got new import and export data prices in today. On a year-over-year basis, they are slightly ticked up. We like to look at these things for thinking about kind of the inflation measures. Are we importing or exporting those type of inflation data? But what you can find here is that prices in general are slightly up. And so this inherently is somewhat inflationary. It's not the end all be all of hyperinflation. But again, this is just something to keep track of, as these are things that go into our overall system for consumption. And if you look at the prices paid, I also find this very interesting because this is something that leads into the inflationary front, both on the manufacturing and services. Even with weak reports, you're still finding that more people are responding that they're paying more for their input costs on the manufacturing and services than the fewer that are reporting that they're not paying more. And so from this standpoint too, it's kind of like the worst of both worlds, right? You're not getting the aggregate activity out of the services and manufacturing, and simultaneously the input costs are going up as well. There's also a sub-index within these that show labor as well, and both of these have been relatively weak as of late for both services and manufacturing. So I bring all this up because this is kind of measuring the aggregate activity. And when we talk about, the data being mixed as of late, this is where you're finally starting to see some of that degradation in the consumer linked area, specifically on the service consumption. But again, you augment that with something like retail sales today, where the previous report was revised up, pretty strong numbers in nominal retail sales today. So you get kind of this mixed bag behavior bouncing back and forth. And so that's why I think what you found is that markets have kind of been somewhat range bound in the bond market. The bond market wants rate cuts. It's asking for them. It's pressuring the Fed like it really was doing at the beginning of this year. And you're seeing that focus on kind of more the negative data than the positive data out there today. So even with retail sales being positive, bonds have rallied a little bit today across the curve. And so kind of decomposing the inflation, we always think about it in two big pieces like the market does. There's goods and then there's services. And this is core CPI. So this strips out the commodity prices. So food and energy, who needs those? So those are stripped out of here. But what's very interesting is that you look at this is the contribution to CPI. So it takes the weight of this component within CPI and multiplies it by the performance of that cohort to give you that overall aggregate contribution to CPI. And you can see here what's really helped the core CPI number has been this goods deflation. So you look at the bottom down there and you can see that goods is actually detracting on a year-over-year basis more than it has at any point in time over the last 10 or 11 years. Now, this is kind of a little bit of a challenge because I think if you go out there shopping and looking for goods, although I think it's Prime Day, one of those sales out there, you probably don't feel that goods prices are going down. Some of these are what we call the hedonic effects, or the adjustments that economists use to say that you're paying the same price, but you're getting more out of that. And usually the example people use, like automobiles and fuel efficiency and things like that. So even though the car costs the same, it looks deflationary because you're supposed to get more out of it. So I think some of those effects are going on there. It's not that we're seeing this reduction in goods prices, but notice here too that that beige area, the core services ex shelter, is still pretty stable. If you look at that contribution, it's been really since we opened the economy back up after the doldrums of the summer of 2020. What you see is that contribution has been somewhat stable to the overall pie of CPI. And what's really been the elevated piece has been shelter. And the good news is the shelter inflation is starting to go down. We're seeing this in new rents data as well. If you look at the new rents being issued, they're actually contracting a little bit year over year. They're still elevated over the last 4 or 5 years, but they are indeed coming down somewhat. And so that tends to lead the OER, the owner's equivalent rent, which is a big piece of the shelter. So potentially we're on this glide path. So if we want to listen to the chairman, his word, he hasn't made up his mind yet. I don't really think that July is in play when they meet at the end of this month. But it's starting to look like maybe September is something that they could actually enforce the first cut. And by doing so, that probably means that they're not doing any consecutive meetings. If they got in that kind of cadence of quarterly, maybe that's what it looks like. But as of right now, the bond market has, roughly over the next, call it, 15 months or so, it has about 7 cuts priced into the market once again. And so here we are. If that rhymes for you, well, if you think about January this year, that's where we were at the beginning of this year. There would be 7 cuts in the market, although they would be over this calendar year, this 12-month period. So we'll have to see kind of how the data continues to perform. I'll talk a little bit more about inflation. We'll also focus on labor because I think that's really what's going to be the focal point of the Fed going forward. Remember, their dual mandate is price stability and full employment. So here's Jay Powell's favorite measures that he doesn't talk about anymore. These were the data points he used about, I'd call it 9 months ago or so, because they were very supportive. This is called Supercore. And the Supercore is that you take the core data from the preceding page. So coming back to this page right here, you take the core data and you strip out the shelter component. And you're left just simply with what's left there is the core services ex shelter. And that's what Jay Powell was calling Supercore. They did it on PCE. We kind of use them interchangeably to show these things. But you could see here that it wasn't, the story just stopped improving. And so they stopped talking about it. But you can kind of see here that it's hooking down a little bit here as well on a year-over-year basis. But in general, this is still not something that's very comforting. So let's pivot from the kind of inflation data. Let's talk about the underlying labor market. Well, if you go back over the last 30 years and you kind of look at what's happened in the non-farm payrolls, there's also something called the household survey. So the non-farm payrolls, we refer to as establishment survey because it's been around longer. The household survey is also trying to convert that into payrolls. And what you can see here is that you're starting to see a big divergence between these two series. And they're both survey data at the end of the day. And so the response rates haven't been great post-pandemic, but you can see there's a huge divergence as of late between what you're getting in the establishment and the household surveys. And so this is kind of the gap you used to see back in the late 90s, but that gap back then was when the time series actually got adjusted a bit. So that kind of aberration was a change in response to the way the surveys were indeed conducted. And you can see it sometimes the household's been better, or it's responded with more jobs than you get in the non-farm. But in general, you don't usually see this kind of discrepancy. And so what gives in this, there's been a lot made about this of folks saying, well, the models are bad, the adjustments are off. There's also the immigration concept that maybe that's not being captured completely on the other side. And another story is the part-time employees, where on the household survey, the question is, are you employed? It doesn't say how many jobs does one own, or one not own, but does one work at? And so another thing I like to look at is the reason that someone would be part-time, because a lot has been made in this cycle about there's more part-time workers out there than there has been, and that data does come out of the data. But if you look at the bottom, the bulk of that, the bulk of people that are employed that are working part-time are doing so for non-economic reasons. So that's potentially they choose to do something like that. Maybe they only want to work 30 hours a day, maybe, or a day, it'd be tough to do, 30 hours a week. Maybe they have to take care of some family members. Maybe they want to have the side hustle. And so you put all this together, and you can see here that we've had a very high dependence on part-time workers for a very long period of time. And so that's what the bottom line shows you. There was a little bit of change in the questioning. That's why you see that big jump in 93, where they adjusted the way these were being calculated. That's why you kind of see that rotation there a little bit between that blue and red line. But notice some people that are working part-time for economic reasons, which is the top panel. It's 4.2 million. And so that number is still growing a little bit, but it's nowhere near kind of that ramping function you typically see during like a recession. And so again, these recessions are defined after the fact, but usually you start to see people that are working fewer and fewer hours simply due to economic reasons. And so again, this is a chart we like to look at. It keeps me on watch for what's going on inside the labor market, but it's not something that says that something has changed massively about the dynamic of our workforce. It's really just kind of back in those long-term trends. But the one thing that is kind of also disconcerting is that the unemployment rate has went above its moving average the last 12 months. And if you use the 36-month moving average, you're right at that as well. And these historically have been good indicators to indicate when the U.S. economy is about to roll into a recession. And usually the recessionary behavior comes because people lose their jobs. You lose your job, you lose your income stream. You lose your income stream, you consume less. And so it's a pretty straightforward kind of mechanism there. But again, if you look at the labor data, what's really strange about that, we've seen unemployment rate rise, but you haven't seen meaningful upticks in continuing claims or in terms of initial claims. And what these are actual reports that come from the various state governments, where, remember, unemployment insurance comes from each individual state and there's different policies. But they report how many people filed for unemployment insurance. So remember, you have to go file the report. You have to adhere to that criteria. But also who is also continuing to receive those jobless claims. And so this is some form of support. And you can see that slope of the line did increase in 2022. If you look at today, it's about 1.8 million or 1.85 million folks that are still out there getting some form of assistance on unemployment claims. But you're really not seeing, at least to my eye, I don't really see a big trend here. And so what we'd be concerned about, it's not what we want to see, what we'd be concerned about would be that orange line going up meaningfully. That is, people are staying on the unemployment insurance and not being able to transition back into the workforce. You have seen the initial claims tick up. Initial claims can portend for higher continuing claims, but if that line in continuing claims is staying relatively flat, even with those upticks in new claims, that means they're clearing the market. And so that's one way to look at kind of the data as well. And we get that on a weekly basis, so it's a little more contemporaneous than waiting on the monthly jobs reports. But one other thing that's happened of a more balance in the labor market is you're seeing that the job openings have come down meaningfully. And so you're starting to see a convergence between the number of folks unemployed and looking for work. So these are the folks. So what I showed you before were those getting benefits. These are also people who are looking for work as well. But that convergence between the job openings and unemployed is starting to be at one of its tightest levels. And we did see this, back in 2018, where there were more job openings than people looking for work. Sometimes there's a skill mismatch there. But again, when you look at that kind of imbalance there, it's pretty much as big as it was still today in the number of workers, that gap there being higher than it was back in 2018 and 2019 at its peaks back then. But one other thing is that the job openings rate has come down a little bit. That means we are filling jobs, but the quits rate's been relatively stable. Much was made in 2020 and 2021 on that purple line at the bottom about the great resignation, and people have all this money, they're not going to do anything, and so the quits rates, there were so many jobs available. But the number you see today is pretty stable to where it was kind of that post-GFC era. So I don't make a lot out of this. If you kind of take the data on a short term, you could say, oh, the economy's softening, people don't want to quit, the hiring rate's going down, the job opening rate is going down. That's true. But in the context of the last 20 years, the quits and hires are relatively stable. The opening rate has come down a little bit. That's pretty much reflective of what you see in that blue line up top as well. So there is more balance in the labor market. I would be concerned if the unemployment rate got to like 4.3, 4.45, something like that, because that would be a meaningful degradation in the overall labor force. But thus far, it's been relatively well contained, at least in the aggregate sense. And you're starting to see pressure on wages come down a little bit. A lot of that, people draw the parallel Jay Powell does of this previous chart here of the kind of ratio of the unemployed to job openings. That puts more pressure on wage growth. But you can see here that wage growth is still meaningfully higher than it was. Whether you look at the Atlanta Fed, the Atlanta Fed version is simply using the same people overall, same person year to year, and so it compares where they were. So it's trying to control for kind of job differences out there. Where the average hourly earnings, it changes meaningfully based upon the composition of the labor force. So that's why earnings went up during the pandemic. Is a lot of the low end jobs just went away for those few months. And so if I look at this, I don't know what level is consistent with 2% inflation. That's what Jay Powell keeps saying, that these aren't consistent with inflation. He doesn't tell us what the numbers should be, but they are somewhat still relatively elevated, which is good. So that means the worker, if you look at inflation right now, the inflation data coming out around 3% or so, effectively means that that the worker is keeping pace with inflation. But why is sentiment so poor? And so if you think about why sentiment's so poor right now, I think it has to do with the chart I show on the screen here. And if you listen to the top of the hour, it was something I was trying to point out on one of those media programs. But the issue is not the year-over-year rate of inflation, it's the cumulative change. And so when you ask people about how they feel today about the economy, are you better off than you were, say, 4 years ago? People respond more in the negative than the positive. I think it's because of this chart here. It's the fact that the cumulative inflation it's what's really scarred people's memories. And so even though that the average hourly earnings have somewhat kept close to inflation, people don't feel that they're making progress because they remember the good old days. And I'll say the good old days, and when they're thinking about it, it's typically some reference point in your life. And I think we all kind of have this anchoring in our lives of remembering the world before the pandemic and after. And that's where you hear the references, especially in these political surveys or people that are asked about inflation. Even though in a lot of instances inflation has stabilized a lot, they're comparing it to a time when prices were meaningfully cheaper, and that is pre-pandemic. And so I think this is the biggest challenge, right now in the overall economy. Even though you have the stock market at highs, you have an economy that has grown above potential. It's continuing to grow on trend. Asset markets are well, housing markets are well if you're an asset owner. And so you put all that together, you would think people would feel that we are in the roaring 20s. But I feel that it's this cumulative inflation rate that's really scarred people's memories, and what makes people feel meaningfully worse off. And again, if you're not an asset owner, you probably are indeed worse off. And so we make a lot about the savings rate. The savings rate is low. This is this is the amount of savings for the disposable income that someone has. And so again, this level is kind of low. It's a bit lower than it had to be before. Maybe that's people are not saving as much, but also savings rates, or let's just say the yields you get on the savings account, or at least a money market account, are meaningfully higher. So maybe there's less money that needs to be put in to get that same kind of savings income that folks are looking for. So it's been pretty stable in this area for really the last, I'd say, 12 months or so. But it's always something I like to look at to see, are people, just not saving money because they're out there spending, and it's just the necessities of life. But the other thing that's kind of troublesome is the delinquency rates we're seeing across various kind of consumer types. And so when you look at the different kind of loan products out there, whether it's credit card, whether it's autos, whether it's mortgages, you're seeing an uptick in the delinquencies. And these are what we call serious delinquencies. This means you're at least 90 days late. So it's not that you went on vacation and just barely missed your payment because you didn't mail the check in time. These are people who are indeed delinquent. And so what you're seeing here is that there still is this deterioration. that is happening among various loan types. And so if you look at some of the earnings of some of the credit card providers and stuff, you've seen charge-offs. You see this a lot in the auto industry as well. And so it's just something to keep your eye on, that maybe things aren't as rosy. And if you broke down each one of these two into kind of the FICO score borrower or essentially income strata, you would see that it's most pronounced at the lowest credit quality as well as the lowest income orders. A lot of times those are highly correlated. But in general, this isn't a, rich people are defaulted on their credit cards. This is something about, again, I think that previous chart means a lot. It's that cumulative inflation. It's built up. It takes a toll on you. And eventually, again, these higher rates are feeding into the system. But the thing is, we still have liquidity in the system. And so this is a chart that I think is a very powerful one about what we did on just kind of the, if you look at the post-GFC to pre-pandemic trend line of M2, you could actually take this chart back, 50 years, you get a very similar picture. But the difference here is that the amount of money that we put into the system was meaningful. And so even though we had this contraction in the monetary base last year, you started to actually see it go back up a little bit as well. So this is what I'll call the excess liquidity. I know much is made about excess savings out there, but this is what I'll call as excess liquidity that we put in the market. And, I don't know, if you take this where the trend line should have been 18 trillion, we're sitting at 10 trillion today. You think about that percentage basis, well, that's almost effectively what the cumulative CPI was, right? Almost a 20% increase. And so to me, it's not shocking to see that we got at least if you took kind of long-term CPI trends tacked on the excess, a lot of it could be explained by essentially this increase in money supply. Well, also the money had to go places, and it didn't just go in consuming, durables and things like that. It also went into financial assets. And so we've seen that as well. The budget deficit's getting better. It's getting better at the margin. We were at like a negative 7% of GDP. It's helped that the economies grow a bit. It helps that we haven't been spending as much, but it's just a very, very ugly situation when it comes to the budget. And as we've talked about many times, look at the average interest rate that the Treasury is paying. Treasury pays on all of its kind of coupon debt. So these are things that are not T-bills, but anything that has a coupon on it. And you can see that the higher for longer has really hurt the Treasury's position. And by the way, there's a meaningful amount of debt stock that needs to roll over the next couple of years. So I think it's on the magnitude of like half of it rolls over the next 3 years. And so if indeed we have this truly higher for longer, we know that it becomes more and more problematic. And so this is kind of the forecast. If you look at the net interest, instead of looking at as a just coupon or as a function of GDP, kind of think about it like a balance sheet. The net interest they're paying as a percentage of tax receipts, which is the revenue that they receive. You can see here that we're at a very elevated level. We've been at high levels before. What was that period? Well, that's when we had to roll over debt from a very high interest rate. And we spent a lot under Reaganomics in the early 80s. And so we increased the debt, we increased the deficits while we had high interest rates. That kind of led to that environment. That looks like the path we're going to have to face in the next couple of months. And if you take the CBO's forecast, and the percentage of revenues never assumes a recession. Thus, you always have a positive kind of revenue stream there. You can see that their expectation is it goes up pretty meaningfully over the next, let's call it 10 years. So all in all, it's a very grim picture at rates where they are. Maybe that's why, the bond market and others are just cheering and hoping for rate cuts as well. Lastly, I like to focus on the small business as well, because these people have to go borrow at SOFR type rates. This is where it shows up in the marketplace. You can see here that if you're trying to get a loan in the SBA market, you're paying something close to double digits. So, a lot of us work in the financial markets. We sit here and look at corporate credit and just assume that all corporations are paying corporate credit spreads and rates out there. Well, that's the nice thing of being large and access to capital markets. If you have to go to a bank, your picture is a lot more dire. And so potentially that's why you haven't seen so much expansion on the small business front. They're just trying to service it, get through this period, make sure you keep the lights on. Hopefully, rates can come down a little bit, and maybe that leads to a little more expansionary behavior. And so not shockingly, when you survey small businesses, the optimism is quite low. Not shockingly, this is what the rate hikes, you can see it right in this chart, that it really had a devastating impact. And then lastly, this leads into essentially hiring plans. So what we've done here is the red line is the unemployment rate, so it's inverted. So going down on that red line means the unemployment rate's going up. And you can kind of see that this usually is led by essentially small business hiring deteriorating as well. And so you can see kind of here in this area that, the sign you're getting from the overall market, it doesn't look extremely positive right now in terms of hiring, but it still is indeed positive. It's just not in a meaningful manner. And so not shockingly, probably if you have to borrow at 10% and that's your working cost of capital, it's a little tough to be wanting to expand. So let's talk about the markets. I'll jump into funds. I just want to cover a couple of things here. I'll be a little quick so we can jump into funds in a little more detail. Volatility has come down. The blue line is the volatility of the bond market. Rate fall has been moderating. It's because the economic data has been more mixed. We haven't had these kind of whippy reports where you have a really bad report, a very good report, and the market's trying to figure out, does the Fed hike, does the Fed cut? I think that everybody thinks the hiking cycle's over at this point, and now it's just a matter of when does the Fed cut at this stage, and that's brought bond volatility down a lot. But you can see the rest of the markets have had dampened volatility for a long period of time. It's really been rates that have been the problematic thing. It's really since the Fed started hiking back in 22. And so if you look at the kind of performance data, it's a little stale. We did it as into the quarter. The bond markets have done a little bit better as of late. I think everything on this screen is now positive if you updated it through last night. But you can see really the pain points have been the high quality sectors, treasuries, agency mortgages, IG, and that leads into the US Ag. Those are the three main components. But what you found is that things that are off index have done quite well this year. And they've at least kind of earned roughly the carry in that area, or their interest rate component. Maybe there's a little bit of, a little bit of weakness of rates in there as well. But you can see here in the non-agency RMBS market, returns of 2 to 6%. If you look at kind of the CMBS market, the lower quality stuff has done very well year to date, up over 12.5%. If you look at asset backs, again, by credit quality, somewhere between, call it 2 and 7%. The CLO market has been very strong as well. If you go to the triple B, or even in the kind of mezz debt, and the double Bs have done extremely well this year. By the way, that's practically mostly carry. The triple B CLOs to SOFR today, assuming no rate cut, they yield really in the 9% range or so. So you'll see we're using those in the closed-end funds as a good investment grade way of getting kind of high single-digit yields. The high yield market has done better than IG. That a lot of that has to do with duration. Again, it hasn't got hit as bad with the interest rate sensitivity. Loans continue to be a very strong performer here. You can see a lot of that's driven by the lowest quality in the triple Cs. And then lastly, EM's kind of a mixed bag. It just kind of sits in the middle here. So what you see here is you've been rewarded for risk taking year to date. That's why the closed-end funds have done well. These are kind of generic indices. What I'll show you is also when we get into the funds is kind of what the type of stuff we own in there as well. As you can see, credit, as I said, CMBS being some of the best game in town, and the high quality stuff has been the worst. Looking at the yield charts, plotting these four kind of pieces of the curve together, what this signals to me is I think we've seen the peak in yields for the cycle. Those highs were put in back in 22. I'm sorry, back in like late 22 is where we started to see that, and then we got another retest in 23, and here we are right now in the market again, trying to get directionality. If I look at all of these charts and I zoom in very closely, what I would see is that most things are at the middle of their range, if not closer to the bottom of their most recent trading range. So again, yields are pretty flat across the curve. Notice 2s and 30s yield the same today. So it's been within a basis point or so. The 2s 30 spread is it's positive or negative, but you're starting to see that where the front of the curve is trying to price in essentially that the cutting cycle coming through, and the back end's obviously showing some concerns about the long-term tenability of the debt service. And so most people, when they think about the inversion of the curve, use 2s 10s as we call it. It's the yield of the 2-year minus the yield in the 10-year. And we've now set a record for the most number of weeks at least in the last 45 years, of inversion in the yield curve. And the one thing, it wasn't as inverted as you saw in the late 80s. Some of the reason for that inversion also was the level of rates, right? When you're in double digits, you can get a more extreme kind of inversion there. But this has been one of the deepest inversions outside of those where we were, the 2s, 10s were about 130 basis points, I think, at its widest. But look at the chart at the bottom. These are the number of consecutive weeks of inversion. And now we're really pushing up on 2 years at this point, 106 trading weeks. So again, as you start to look at this, doesn't say that this is that this is a signal that's broken or anything. But as you notice here, that typically once the curve de-inverts, that's when you start to see more problematic behavior. So we'll keep an eye on this as we always do, but that inversion is persistent. But the bond market isn't really signaling anything about inflation. If you take that break-even spread, difference between nominals and tips that make you agnostic to owning the two, the market's pricing 2.2 to 2.3% inflation over the long term. And so for all the considerations, what we saw in the inflation premium coming back in the market, what's really done is it's changed break-even spreads to move up. They probably moved up on a magnitude of 30 to 40 basis points, and that's been really the meaningful impact over this. So the market still kind of buys into the 2% mantra. It's given a little bit of wiggle room in there just because, again, we've seen inflation in the last few years, but it's been pretty calm and contained there. Get a lot of questions about the dollar. Obviously, the dollar tends to be correlated to rates. A lot of it is front-end rates versus the 10-year. Although those have been correlated, the curves moved relatively somewhat parallel. And so you see here that, again, the dollar's been a little bit weaker as of late. To me, I don't really see much of a trend in this. To me, the rates market is easier to focus on today than trying to get the currency right. So all of our funds that we're talking about today are all 100% dollar denominated. Here's just another perspective of how wide yields got in some of these areas. You look at kind of the average of the last 10 years. It should say that it's a 10-year average if you read the footnote down there. But you can see on the high quality stuff, it's some of the highest yields you're seeing in kind of spread product. You have a little bit better than average spread here. They're not nearly at the wides that you saw. Really, the widest yields you see are in the things that are in the highest quality stuff. And so, again, if you look at and you're looking for things in the high single digits, low double digit type returns, they do exist in this part of the market. And you just have to go out there and kind of do the diligence to find it, but also make sure that you're doing the idiosyncratic risk work that it takes. And so because it's a closed-end fund, we take a little bit more risk than we do in our open-ended products out there. And just people ask, well, where can you get yield today? Well, it's in the risky parts of the market. And so looking across this, you can see how many segments of the market have things that do generate a double-digit yield to no losses today. And so there is a big chasm between single B high yield and triple C high yield at 8% versus 14.4%. But if you do the work, you understand the credit, and you feel that you can get through a cycle with that name, I wouldn't want to own a basket of triple C high yield, but I'm happy for our team to pick the best things that they see surviving to that cycle. And maybe, you get an 11 for that kind of risk, maybe you get a 10.5 for that risk. But in general, there are ways of doing that if you really want to get your hands dirty on the credit work today. So I don't think this is an index market whatsoever, especially where we are. I think it is the time to be doing the home markets, to be rolling up your sleeves and asking the hard questions of where we are on the cycle. So lastly, when it talks about spreads over the last 10 years, you can see generic stuff on the bottom left, low spread, lowest kind of decile of spreads that we've seen in the last 10 years for things like IG and high yield. You won't see really IG corporates in this, but you can still see the parts of the loan market, the floaters, whether it's bank loans, whether it's some of the CMBS market, even some of the agency MBS market still ranks in the top decile of cheapness. And so these are things that we're using across the portfolios as well. But this being much more credit heavy, we're doing a lot of idiosyncratic work. So let me go through the funds real quick, talk about some of the changes we've made. And if there's some time left, I'll answer a couple of questions, which I see there's a couple in the queue there. So going back to the fund, I need to go back to that slide. And so you can see here since inception, DBL, DoubleLine Opportunistic Credit, is the first closed-end fund we launched. We launched that back in January of 2012. It's the smaller of the three funds that we've launched there. But look at the performance of it. These are using the NAV. As Chris said, there's market price around it. DBL trades near a premium today. But if you look at it, 550 annualized rate of return in a market that gave you about 163 if you'd have just been an indexer. And so, during the pandemic, there's a little bit more of a drawdown there. But you can see our recovery has been really, really strong since we went kind of through some of that rate hike too, through the Fed hiking cycle. So again, not much more volatility than the overall ag. We're very proud of the performance of this product. It's one of those that, in a market that's giving you 160 to outperform by 390 basis points or 387 basis points per annum, that kind of stacks up over time. So what are we doing with it today? If you look on our yield to maturity, and here this looks a little different than the SEC yield because, again, just some of the haircuts we apply to things. But you can see here that we have it kind of in the books as a 9-handle yield today. That's what we think it looks like. Notice that fourth line in the table says gross leverage, 12%. That means we are borrowing 12 cents on the dollar for every dollar invested. So for every dollar in the fund, there's $1.12 in assets today. And if you look at the market price, it looks high, but that's a little distorted because of some of the securities we own in the agency mortgage market. And so if you recall, DBL has been designed by prospectus to have at least half of its assets in mortgage-related assets. And we do that from the residential and the commercial mortgage markets today. So looking on the right-hand side of the table under credit, you can see here that we own non-agency CMBS as one of the largest pieces in the securitized space, at least in the mortgage side, about 14% in non-agency RMBS, and then also 18% in agency MBS as well, trying to take advantage of some of that cheapness in that market. You can see CLOs, a very large position in this portfolio. We like them because of the floating nature. It's been a great duration management tool for this product. But importantly, too, we just like the spread environment that we've been in, and we think CLOs have been very attractive. Anything that we try to target a lower duration, we've had a bias towards CLO for the last couple of years. As we just thought that there was a really compelling opportunity there. Again, we don't want this to become entirely a CLO fund, so we have other exposures out there, but that's the main composition here. So picking up 411 basis points relative to the Bloomberg Ag today, we think it's a good position there. And if you think about the risk management, I talked about us having a little bit of leverage out there. Remember, leverage is expensive today. We pay a SOFR plus rate, so it's like SOFR plus 85, I think, in this fund. And so that means the borrowing threshold has to be high. So what you can see here is what we've done, during the hiking cycle. We've actually taken the leverage down a little bit. It bounces around a little bit because we get some pay downs at month end and some coupons coming in. But we're targeting some of the lowest level of leverage we've had in the portfolio really since the life of it as well. So this is just the last 10 years. But the idea is to show you that we've inherently de-risked the portfolio from the leverage standpoint. Why is that? Well, the market gives us more yield today. So this is not a return maximizing fund. We're trying to get a stable distribution yield, trying to turn that into a stable total return through a cycle. And again, be able to withstand some of the volatility and buy some assets that can be a little hairy that we want to hold on to. And the closed-end structure is very good for that as well. So another way of thinking about credit quality is to look at the composition of the portfolio as well by rating type. And if you can see here, the black area is government. This also includes some of our mortgages. So if we buy Ginnie Mae type securities, they show up as government. If they're Fannie Freddie, they show up as agencies. So that's what you'll see the big difference there. So it's not like we have a bunch of treasuries here. They tend to be just kind of Ginnie Mae related inverse and IOs and inverse IO securities. But notice the investment grade area too has become a much bigger piece of the portfolio. And we're using fewer pieces from that agency and government sleeve because there's enough yield in the credit markets on these sides to be able to meet that threshold. And so again, the credit quality in the credit has really moved up meaningfully, and especially with the dynamics going on in the agency mortgage market. That's why we still have pretty big chunk there in that side of the portfolio. So on DSL was launched about 15 months later. It came out in April of 2013. It had a pretty choppy experience. If you remember out of the gate, we launched this into the teeth of the taper tantrum. So within a month or two, we started to experience a taper tantrum. We clawed our way out of that hole. Then we got the credit issues on the back end of 15. We clawed out of that hole very well. Then we got hit by the pandemic. We clawed out of that hole. Then, again, we had the rate rise. This one has a little more sensitivity because of the EM nature of it. But you can see here, we've been crawling out of that hole as well. So put it all together in a world so this one has to be, or this one was sold as kind of a global product, thinking about having an EM focus or the heavy tilts toward EM. There's about 40% of the fund today in emerging market debt. So compared to the global world, where the global bond market's giving you 13 basis points per annum over the last 11 years, at least our fund has been able to do 383 over that. So 370 over the index per annum. Very similar to what we did on DBL relative to its benchmark as well. So again, these are the same folks running these monies. It's the same investment team. You have the same portfolio managers, same macro teams, the same allocators. It's just the tools we're using and the way we're building the portfolios to try to navigate the cycles here. This one has a little bit more yield in it today. Some of that par erosion that we saw at the very beginning. We've had a couple of tough cycles here in credit as well. So this one does have a little bit higher yield on the portfolio. It has a little more leverage for that reason. But if you look at the market price here, 77 cents on the dollar. If you went back to DBL, I didn't make the comment, but it said 105. That's because of some of the IO type securities we have in the portfolio. It boosts the price of it. If you stripped out the agency's mortgages out of that fund would trade in the low 80s as well. So very similar discount bonds. These are names we like. There will be some at-risk securities a little bit through a cycle just because of the credit nature of it. But in general, you can see, looking at the global ag yield at 390, this thing yields about 813 over the global ag. So I'll take this in the horse race all day long compared to investing in the global bond market today. But you can see here that the exposure is a little bit different. So if you recall, this one was sold more as a credit product, not to have those necessarily have all the mortgages in there. As you can see today, we don't own really any non-agency mortgages in this portfolio, just due to some of the nature of things we're finding in the other markets and the higher threshold we have here. Not a lot of that made sense to put in the portfolio. We do have some of the lowest amount of EM that we've had since inception. It's been as much as half the portfolio. Today, it's about 40%, and that's because of the yields we can get in the U.S. market. But you can see here still that consistency of our securitized markets, heavy in CMBS and CLOs. Again, once you adjust for that kind of EM allocation. And then lastly, we have some corporate and bank loan exposure in there. Our credit teams on the leveraged finance side have done a great job navigating through this cycle, especially being able to buy risk back in 2020 and 2021. And they've really been helping drive the boat here as well. So this is really more your traditional kind of below investment grade credit type fund. Look at that at the bottom. You can see 71% today on the bottom right-hand side, showing you that. So this one's going to behave like credit markets. Not shockingly, that's why you see the strong returns that Chris showed you at the beginning. But also true to what we were doing in DBL, we've been delevering this fund a bit as well. Getting higher costs of leverage, spreads have gotten tighter. And so what we started to do is just, kind of pay down some of that leverage at time, make sure we're earning a distribution yield and be able to pay that out. So if you take the credit quality perspective, very similar here too. Again, this is being a more credit focused fund. We don't use as much IG in it, but you can still see thematically that trend of owning more of that investment grade type of parts of the market. And it's some of the most we've owned really over the last 6 or 7 years. So again, very consistent philosophy of how we're approaching all three funds. And then lastly, our most recent offering is we colloquially call it DILY, DLY, the DoubleLine Yield Opportunities Fund. This one was launched about 2 weeks before the pandemic really broke loose. So this was February of 2020. I remember being on a roadshow during all this, and then the world shut down. You could see, obviously we got in a hole out of the gate, just like with DSL, but we've been able to claw way back much quicker. Simply, we got a good set of assets in here. The composition is a bit different as well, but we weren't immune to kind of the drawdown during the rate hiking cycle, and then we've been able to really claw most of that back. And if you look at the NAV, it's at a new high today. So in a down 120 per annum world, which is what the bond market has given you over the last 4 years, Let that sink in a second. Over the last 4 years, the bond market has lost you 120 basis points per annum. And daily during that period was up 312 basis points. So this one's done a little bit better relative to its index, albeit over a shorter period of time, but more than 430 basis points of excess return relative to that aggregate. And by the way, look at the standard deviation of this as well. Even on a levered bond fund, we've had lower risk than you see in the Barclays Ag. So all in all, we're very, very pleased with the way these funds have performed. We have to be invested. We have to try to generate these yields. And you can see here, if you look at the yield decomposition, the bottom left, about 10.5% yield today. That's about 550 basis points over the U.S. Ag. You can see the gross leverage at about 18%. I'll show you what that history looks like. It's less than we've had, but we're near kind of that average kind of rate we've seen there. And in this fund, it's supposed to be much more credit centric, but not have that EM tilt. So again, you can see our biases here. Highest position in non-agency CMBS, and then CLO in the securitized markets. A close second with non-agencies. A lot of that is the seasoning and everything of when the fund came around, so they work a lot better for this fund. Then you also see that leverage finance exposure, right? We're getting to about 30% of the fund. The EMD is dialed down a bit in this fund because it doesn't need to be in that area. And so from that standpoint, we like this as a diversified mix as well. This one does have a fair amount of below investment grade, once again, and unrated securities. Unlike our open-ended funds, when I talk about unrated, a lot of our unrated, I say those securities are more comparable to investment grade. In these funds, they're not. They're more comparable to below investment grade as well. So when we look at the credit quality, we'll see that across the portfolio. But if you look at the leverage, I said, we were kind of peak leverage back at the end of 21. When there was just great carry in the world, right? You could buy high spread assets, borrowing costs were cheap. Obviously, as time went on, we've kind of migrated the portfolio up a bit in quality. We've brought down the leverage by about 7 points or so. And again, it's very consistent. And that's one thing that we harp on with the investment team at DoubleLine is we want consistency across our products. We are an active manager. We make active bets. We have active views in the world. And we live and die by them. They're not always going to be right. There's going to be times where we're going to be off sides. But the idea is that, again, you're just trying to use the different tools in there, use the different guidelines of the funds to get people through various experiences. And so I would say that for how dire it looked at the first month out of the gate of launching this fund, to be able to report that we've done 430 over the bond market per annum, I think is a pretty strong achievement that at least I personally am proud of the team. And you can see on the credit quality, as we got invested, obviously we had much more below investment grade, and that kind of migration I'm talking about shows on the slide there. So with that, those are my comments on the funds. I'm happy to take a couple of the questions here. I know we've been here for almost an hour, so I'll try to go through it relatively quickly. So someone's asking, will we open a muni fund? When we feel we have the expertise to do so, we will open one. So thanks for that. Do you believe the unemployment data truly reflects the actual participation rate in the labor market? I don't know the answer to that question, but I think that there is some of this data that's not being captured, through some of the immigration stuff. I feel like the unemployment claims to me are one of the cleanest measures. And why I feel that way is that it's not a survey. It's people who lose their job and say, you know what? I worked, I paid in the system. I'm going to go get my benefits that I deserve. And so I think there's less reticence to doing that. Maybe there's some fraud in that data, but that's people who shouldn't be getting it. So I don't think there's this pride where people say, I'm too good to go file my unemployment insurance if I get laid off. I think that happens. Now, one of the problems with that is that if you get laid off and you get a severance, typically you can't file unemployment insurance for that because you're still technically employed. So maybe there's some of that that's in the data set as well. But I think that the data is as good as it can be. But at the end of it, there are questions around the data set, but it's the best that we have. And anecdotally, when I go around, I travel a lot for work. I go to big cities, so I don't get to see the picture of every place across this country. But I'll tell you, in the top 10 cities in this country, if you go to them, they are packed. They are busy. People are out. People are doing things. So again, that's anecdote. Doesn't mean there's not a recession, but it feels like the data looks pretty accurate for what's going on. So again, time will tell. So the question is, maybe the Fed should just aim for deflation to bring prices back where they were. Oh, yes, my friend. I love that question. The problem is that the Fed hates deflation. This is why average inflation targeting was a dumb idea, because the average inflation is only if it goes too high. I'm sorry, if it's too low, they'll accept some level of inflation. So on average, it looks okay. The problem is they will not accept deflation because they're afraid of the deflationary spiral. So for you and I as consumers, deflation works well because we just hold back consumption and wait for prices to get cheaper. But it's that waiting for prices to get cheaper that you can destroy the overall economy because essentially no one consumes until prices hit bottom, companies go out of business. So there is, as a young analyst, I'm like, why can't we just have some deflation? It's good for everybody. Unfortunately, the system is predicated on this idea of being able to generate nominal profits. And if you have deflation, you're not going to be able to do that. So although it's a heroic effort in your question, I love the question. Unfortunately, it's not one that I think the Fed is going to try to do. So thanks for that. Looking at money supply, how that affects the probability of instability in markets. Does it shift from a long-term to our macro view? I think this is why we have the inflation data we have. I think this is part of it. I think that, Mr. Friedman was right. It is always a monetary phenomenon whenever you see inflation, and that's kind of paying the price for that. So does it lead to stability? I think that's why asset prices have done what they've done. People need to put the money somewhere, and so let's do it. Someone is a big fan of mine, says, I love all three funds, so thanks for that. Explain your thinking, use of duration across the funds, why they're a little bit different. The difference is that what we're trying to do is we're building the portfolio at the asset level and then controlling duration after that. So DSL will be a little bit longer, as you're pointing out here, versus DILI, because we have a lot more emerging market debt in there. And emerging market debt, what we're buying is in the 5 to 7 year parts of the curve. So from that standpoint, that moves the duration out a little bit and having that higher allocation there. You referenced DILI being a couple of years shorter. Well, DILI is a securitized credit heavy and more of a loan and high yield, which is on the shorter parts of the market. So inherently, it's the asset mixes that are driving that. We do have a couple of rate overlays on both of those portfolios right now to extend the duration a little bit, but there's not a lot in there today. So that's the reason for the rationale across that. It's more of a build it from the bottom up and do a duration overlay at the end. And then the last question, could I see with a scenario where inflation ticks higher and the Fed increases rates again? Yes, but not right now. I think it could be on the table at some point next year. It depends on kind of, the fate of some of these elections and the like and what that all looks like. But I think that it's off the table for this year. And I don't think you should be thinking about that. Could the rate cuts go away this year? Yes. I think that's a bigger risk that they would go away, but I don't think that interjects a hike at this point. So thank you for everybody. Thank you for tuning in today. I appreciate all of your support. Thank you for your interest in all of our funds out here today too. This is where we take a lot more of our credit risk and express these outright views. And so we appreciate all the support over the years for our closed-in franchise. And again, the team is grinding hard to find good opportunities in there and not just put donut holes in the portfolio. So thanks again, everyone. Enjoy the rest of the summer. Our webcast schedule will be back in September with our CEO, Jeffrey Gunlock, and Andrew Hsu, the portfolio manager there, talking about the total return fund. So until then, take care, everybody, and best of luck through the rest of the summer.